Okay, hi everyone. Welcome back to the show, and thanks, Chip, for joining us today. Chip, you're over at Tribeca Capital or Tribeca Venture Partners. Do you want to just give a quick intro, 2 minutes, who you are and what
Sure.
you're doing at the moment?
Sure. So Trip Meakem, born and raised here in the New York area. I went to Cornell undergrad. I always joke I was a history major. I didn't even have my own computer. I used to borrow people's Macs, these little things with like a keyboard that would pop off the front to do papers. I graduated in 93, and then in 95, I started one of the very early web ad networks. That through many twists and turns and near bankruptcies and then a three-way merger became a public company called 24/7 Media here in New York. It's kind of one of the big Internet 1.0 companies in New York. I actually went back to business school. So I went to Columbia Business School after that. And then I went to the venture side. So a couple of different platforms, but always early stage in New York. And then in 2011, my partner, Brian Hirsch, and I had known Brian for at least a decade, saw an opportunity. New York was kind of emerging then, although, listen, I was a New York tech guy in 1996. So I think it was there back then too. But in that sort of 2011 timescale, New York really did start to emerge as kind of a real critical mass, kind of number 2 market to the Valley, for tech. And so we started a firm that was really purpose built around New York tech. And that was called Tribeca Venture Partners. Now we've got, we've raised 3 early stage funds. We also have a late stage practice now as well. So we've raised 2 late stage funds, and it's been a good run. No complaints.
Nice. So you've gone all the way through, I guess, like the .com bubble and sort of rode that wave up and then seen it come down.
Yeah. And I think, it's really instructive because I think as we came into this last downturn, there were a lot of, and maybe even the majority of venture capitalists had never really seen a down cycle. And, I unfortunately have seen all the down cycles, the 2000 crash, the great financial crisis, COVID, and all the little ones in between. And there really is, there are many hard lessons learned in there that I think are really valuable. And you could see a lot of new firms really didn't know what to do when everything is not going up and to the right.
Right. Yeah. Was that sort of around the 2020, 2021 times that things started getting a little bit
COVID hit, and if you had told me that the venture market writ large would react to this massive sort of global dislocation by deploying more dollars at higher prices faster than ever, I would have said that probably doesn't make sense. And we actually went the other way. We really, I think from, put aside the sort of early COVID, the March through whatever, June, where it was just kind of chaos.
Yeah.
But once the craziness sort of set in, we really went the other way. And so I think we made 1 investment in 18 months and had, 2 IPOs, 3 trade sales. We just decided, hey, now's the time to sell. And I think that was a smart move. I mean, A, we were able to monetize a lot of our investments and return a lot of capital to investors. But B, we emerged without a portfolio of dozens and dozens of SaaS businesses priced at 100 times sales or ARR, right? Which a lot of the market did. But again, I think some of that is a function of just kind of experience and having a pretty good lens as to how these market cycles work.
Yeah. So were there any sort of warning signs specifically that made you kind of put 2 and 2 together and go, okay, we've seen this before. This is where it's going to go now.
Yeah, I always say, here's the trick with early stage investing is within a band, and the band is actually very large, you really shouldn't make investment decisions based on valuation, right? Because with the really big ones, you got to be in it to win it, right? You need to be in those companies to reap returns. But I always say, if I think that maybe the company should raise, 4 at 16, and they end up raising, 6 at 30 or some, okay, fine. It's when I think it's 4 at 16 and they're raising, 30 at 170. Then I say, you know what, I'm not 1x smart. I'm not 50% smart. I'm probably not even 2 or 3x smart. I might be ordinally smart, right? Where things are an order of magnitude off. And we saw a lot of that. And we saw it in our own portfolio, our companies that were maturing and raising capital. I won't name the platform, but there were some hedge funds that came into the market. And, we had a company that raised $100 million on 2 Zooms in 10 days, at a multi-billion-dollar price. And it's, by the way, a great company, but I don't think that value was correct. And I've never made an investment on 2 Zooms in 10 days.
Yeah. What do you think was driving that then?
I think there was... Well, let me ask you a question. Do you think tulips were worth $1,000? Bubbles are part of the human condition. It just is what it is. People, there's a sentiment of piling capital. And it's the other thing you learn with bubbles is they break quickly.
Yeah.
Right. These things happen quickly. Like I remember March and April of 2000, it wasn't like the NASDAQ slowly went down 4,000 points. It just cracked. Right. And when the great financial crisis hit, I remember one of my companies, by the way, poor financial controls in the company, but somehow ended up owning like $20 million of these things called mortgage-backed securities. And one day we went to go draw our cash to make payroll and we didn't have the cash. And it was literally, the 2-week cycle before we had the cash. And this 2-week cycle, now we don't have the cash, except the bank was telling us, don't worry, you have the cash. And we said, well, why can't we pull it down to make payroll? And they said, well, it's not liquid, but it's cash. So the whole financial system seized, right, in a matter of days, right? So bubbles pop quickly.
Wow. Scary stuff. So this is really interesting. How do you know if you're in a bubble at the moment? Because it's quite, I dare say it's quite easy to sort of look back in hindsight, as someone who hasn't lived through this kind of stuff.
Yeah. So, if I had the answer to that question unambiguously, you and I should go do something else because we can make a lot of money, right? Yeah. So now I think, again, I wish I could pull up the graph, but there's an incredible graph that shows bubbles literally from tulips to NASDAQ to all these different, and they all have an incredibly similar trajectory, which is they melt up. Then in the last year, give or take, it's like the dot. And then there's usually, go down so you can see, they go like this, then they go up, and there's a dot on the eye, right? That dot on the eye is the last craziness, and then it plummets. So just Google it. You'll see it. It's remarkably how consistent these graphs are. So the trick is, a ton of the return is actually garnered in that last steep year. So actually, you could be really successful by being a buyer, in the 7th or 8th inning of the bubble, as long as you can sell with 2 outs to go and 2 outs in the 9th. And I know you're English, so that might be a little bit tough, but it's baseball stuff, right? But you got to get out before the dot on the eye. Now, if I had the pattern recognition to always see the dot on the eye, then, as I said, maybe I go do a hedge fund or something. But that's generally, take a look at the graphs. They're remarkably consistent across bubbles.
Yeah, we'll try and pull up some screenshots and see if we can pull those out. But yeah, really interesting. Okay, so let me formulate this question. One pattern that we've seen when we've been speaking to people. I was actually speaking to a guy called Keith at Signal Rank, and he looks at companies that have raised past Series A and sort of pulls all of this data together and says the companies that have raised past Series A, it's something like are 3 to 10 times more likely to return the raise or return the fund than all of the other startups, whether that's seed round, whatever. That's like a pattern that he's spotted. Is that something that you guys are also seeing? Because you invest past Series A, right?
Yeah, in our early stage practice, you usually are the Series A investor.
Okay.
Now, what I will say is, over time, companies are raising a lot more seed capital than they ever used to. So I actually think if you went back, 15 years, what we call seed today used to be A, and what we call B, A today used to be B. But in any event, but when we're doing a Series A, the profile is usually, team tech, good early customer traction, meaning, $1 million plus of revenue, rough and tough, right? And that's obviously not exact, but in that ballpark. But there is very much, they call it sort of the Series A is the choke point in the system, because there's been so much seed capital available in the market. The companies have been able to raise lots and lots of seed capital, which is, by the way, great for company formation. But if you think about all of that company formation and all that seed capital coming to a pretty small part of the venture ecosystem called early stage, like Series A capital, there's a very high hurdle to get that done. I mean, that's why we've chosen to be Series A investors. We think that's the right part of the ecosystem to focus. In fact, in a broader sense, we take a barbell approach. So we have a Series A practice, and then we have a late stage practice. And the late stage practice is, 20 million plus of revenue, profitable, and/or the last capital the company's going to need, full management team, much more mature businesses. And we think that's the way to play it. In the middle is kind of a gray zone. Yeah, no, I think to that earlier point, if you can get that Series A done and you can get 8, 10, 12 million bucks in the bank, obviously, if you're a good steward of capital, you know what you're doing, your chances of success go up dramatically.
Yeah. Huge more amounts of runway, I guess. But does that create a bit of a disconnect with founders then, who've perhaps already raised maybe just angel or a seed round, and who are then going on to raise an A? Do you see a disconnect there and sort of mismatched expectations about what they could raise or what's realistic?
Well, here's the thing I say to a lot of companies. The vast majority of companies should not raise venture capital. Okay. Venture capital is expensive. It comes with a lot of, governance and restrictions and, covenants and all this stuff that I pay lawyers to do. Right. But it's expensive capital in a lot of ways. And, I think what's hard for a lot of founders to understand is, listen, it's really hard to build a $20 million business. And I was way back when, an entrepreneur, and it's really hard. The cold, hard truth in today's kind of economic environment is when you get there, nobody cares, right? There's really no exit environment for the small company. Obviously, you can't go public. And so if you're going to take venture capital, you have to really believe that you can get to multi-hundred million revenue scale and therefore, into the billions of value. And frankly, in the public market structures today, even most of the large allocators of capital really only want to deploy capital into companies that are north of $10 billion in market cap, right? So the whole system has just gotten really big. Like when I started my career, my first several exits were all, software company that got to 10 million of revenue, had raised 6 and got acquired for, $80 million. And you make 4 or 5 times your money. It's a small fund. You stack up a bunch of those and you have a good fund. That was the model for a lot of years, or that was a part of the model. Now it's really a hits business. I mean, you've got to have really big outcomes. I always talk with founders and say, and let me be clear, there is nothing wrong with a founder who takes some seed capital and says, I'm going to build a really good product. I know who the acquirer is, or the two or three acquirers. I'm going to build those relationships. And when I get to 10, 15, 20 of revenue, I'm going to be willing to sell it for $80 million. I mean, it exists, right? But it's a different strategy. And by the way, if that founder owns half the business, nice work if you can get it. That's a good outcome, but it's not what we get paid to do.
Okay. So on this point about the strategy being really about getting those hits, there's two sides of that, right? There's on the founder side or on the company side, it's how do they get the most support so that they've got the best shot of hitting that, as you say, like 100 million plus sort of valuation. And on the VC side or on the investment side, it's how do you find those guys who are most likely to create those hits? So on both of those, we've spoken a little bit about like community. Obviously, there are VCs can create a bit of a community around themselves. Some of the big guys, particularly who are doing things in the content space, have got that brand and that community around them, and they're becoming household names almost. On the founder side, are there things that you think founders can do to get a community or to find VCs who are going to give them the best chance of success, who aren't maybe some of the bigger guys like the A16 and the Grey Lot?
Yeah. I think, I guess I'll start with kind of the community concept around venture because it's interesting. If you think about community, it's like, it's companies, it's founders, it's us, it's the investors, it's like kind of the service providers, and then it's my broad network. Right. And, I think as a venture capitalist, your job is really to sit in the middle of that and use it to generate as much value as you can for your companies and your investors. Right. And I always thought of that as like sort of my job description. And then if you go back 15, maybe 20 years, some time scale like that, to your point, these really big mega platforms started evolving and they essentially tried to productize that function. Right. So they brought in people who literally had titles like community lead and community director. And then they brought in talent director and they brought in designers and all sorts of people who historically weren't at venture firms. They were parts of the ecosystem. They brought it all into their firms. And I think that model, I'll give you an anecdote. I had a company big company, we were looking for an independent director in advance of an IPO. One of these big platforms were a co-investor and they said, oh, great, talk to our talent team. We actually have a person who specializes in independent director searches. I said, that's awesome. Great. And so I reached out, I emailed, and I got an email back saying, great, here you go. Here are the 3 headhunters that we recommend for independent director searches. Now, by the way, I know all 3 firms. I know people at all 3 firms. And I was thinking, that's a pretty good gig. You basically just send out emails saying you use these headhunters. So what is instructive in the example is, I think the mega platform approach, you lose all the nuance and all the sort of personality. Like I should know this. I want to say I'm on 12 boards, which sounds like a lot, but in the kind of modern venture ecosystem, it's not that many because holding periods have gone up so much. But every one of those founders, boards, teams, investor syndicates, companies, products, markets, they're all different. And they all have a lot of nuance. And the headhunter that is the right fit for company A is not for B. And the technical advisor for company C is not the right one for company D, and et cetera, right? And there's no way I can impart that intuition into a platform. And maybe I can, by the way, maybe I can put it into an AI instance of myself at some point in the future. But right now, I can't do that, right? And I think a lot of the big platforms, it's funny, anecdotally, I know that when you go to the websites of a lot of the big ones, that title doesn't really exist anymore. Community lead, all this stuff. I don't see it anymore. So in any event, but that's community. And then in terms of, entrepreneurs accessing the right investors, I think the best data source for founders are other founders.
Yeah.
Just simply, it's kind of old school, but it really is true. And if I tell you about our portfolio, most of our really good big companies are either direct relationships, like we know the founder, or one layer of the onion removed. A founder. Actually, I have an email that I used to use in one of our investor decks, and I was lucky enough to be involved with a company called AppNexus, which was a guy named Brian O'Kelly, created what is now programmatic advertising, which is literally display advertising is 200 billion, and 185 billion of it is bought and sold programmatically, and kind of created that concept. A lot of people created it, but Brian was an important part of it. I don't even know what the time scale was, but many years ago. But I got an email from Brian saying, "Hey, bad news, 2 of our best engineers are leaving. Good news, they're starting a company." And then the next paragraph says, "Hey, Abel and Sammy, who are the 2 guys, meet Chip. He's been with us, all along. He's on our board. He's great. He can help you. You guys should connect." And then we invested in that company. That company got acquired, and we did well, et cetera, et cetera. And I actually think in many ways that little email thread is sort of the instantiation of what we do. You work hard for your companies, and you get the trust and respect of your teams, and they become an extension of your firm. And by the way, sometimes you're not always, happy-go-lucky and friends with all your teams. It's tough. Sometimes things go wrong. I have founders on my reference list that are people that, we didn't replace, but we brought in, CEOs and senior people to help them. And they're happy we did it because they ended up doing really well.
Yeah. Yeah. Well, it's such an interesting point. So you're saying that a lot of your stuff is very direct within your existing network and people and board positions. Do you think that's because you are primarily looking at like Series A and a lot of later stage stuff?
Yeah, I think we focus primarily geographically. We focus on New York, although, post-COVID geography has gotten a lot more blurry. Companies were already starting to be all over the place, but COVID, like in many things, accelerated that trend. But for the most part, we've deployed a lot of our capital in New York. And that's because, we have a very deep, rich network in that community. So, it's kind of like real runtime stuff. Like, hey, one of our companies is hiring a VP of sales, and that person provides a reference list. Okay, well, we can go very quickly and find 5 people that are not on that reference list who have worked with that person who can give us the real scoop, right? And that sounds kind of mundane, but any founder out there will know if you hire that head of sales, it's going to take 6 months to figure out if he or she is good or bad, and it's going to take another 6 months to get them out of there. And maybe if they're bad, by the way, and hopefully they're great. That's the upside case. And if you've just raised your Series A and you've got 18 months of capital, 12 months of it's gone on one bad hire, right? And so that's where it's not sexy, and it's very kind of mundane stuff, but it makes a big difference.
Just having that trust that, a reference is who they say they are, and there's experience there. And nice. Okay. Well, one question we have then is a lot of VCs that we speak to say that, they might have sort of 1,000 deals come across their desks every year. And so the number of startups out there isn't really a problem, particularly, like AI and things is making building apps and building landing pages and marketing systems a lot easier to spin up. Are you in a similar position, or would you say, do you have any issues around like quality of founders that you reach, or is that not really part of your model?
Yeah, listen, in terms of raw numbers, I don't even know. We track it all. I could figure it out. It's thousands of companies per year, right, that come in through our system. And I think one of the differences, so we again have sort of a old school version of the business where, our funds are relatively small, and we tell our investors our investment pace, quote unquote, is when we find the intersection of team, tech, market, and macro trend that we think can build $1 billion company, we invest. That might be once a year. That might be 10 times in a year. But that's it. We really believe at the early stage, every time you invest, you have to believe you can return your fund or a multiple of your fund with that company.
Yeah.
Right. And that is a rare thing. I mean, the reality is, and I should have the data and we could pull it up separately, but the number of companies that reach a billion, and nowadays people talk much more in terms of 10 billion, right? 10 billion market valuation outcomes is very small. It's a very small part of Uber macro company creation. And the reality is, if you catch 2 of them per fund, you're probably top decile in your returns. Yeah. Just the way it is.
So how do you strategically go around trying to find those top performers? Is it just a case of as and when it comes up, or do you have strategies in place to find them?
It's kind of a mix, right? There's a general, you have to be in the community, and you go back to my example of founders, right, who are sending you deals. That also multiplies to everybody in the community, right? Yeah. Lawyers, I mean, everybody who's out touching companies. And then we also tactically think much more, we will at times pick a vertical that we believe, or a market space that we believe has real opportunity, and really deep dive in, with some junior folks who will really deep dive in and proactively look for companies. But I really believe, and this is a bit of the cynic in me. So when you hear someone like me expounding like this, and I tell you, oh, my favorite sector is X, I'm going to tell you the truth. The truth is X is the last deal I did. Okay. Very few. Now, there are venture firms out there that do deep dives in sectors, but I'm a generalist. And because I believe that if I am trying to really specifically look at one slice of venture market, of kind of venture company creation, then I'm somehow implying that I'm smarter and or have a better insight than the entire crowd, or the cloud of company creation. I'd rather see the entire cloud of company creation and apply pattern recognition to that cloud than to say I want to look at a slice of the cloud, if that makes sense. And by the way, there's a lot of folks who take the exact opposite approach. They look at the slice and they've done very, very well.
Yeah. Well, that's an interesting take there, is sort of applying fundamental principles and things that you've observed with perhaps an outside perspective that actually might help spot things that other people are missing into whatever industry the deal is in.
Yeah, and listen, I'll give you an example. I just closed an investment in a company called Swivel.ai in New York. It's applying AI and automation to ad operations. So this is a space I know very, very well, right? So I remember way back when I started this ad network in 1996, and about 3 months into it, I realized a couple of things. One, we're actually in the fraud detection business, because if you're paying people based on traffic to their website and clicks on their website, they will do all kinds of crazy things to boost their traffic and boost their clicks. Two, somebody shows up with the I Love the New York Yankees site. Great, they're in the network. The next one is I hate George Steinbrenner. And there's a lot of content in there about like doing bad things to George Steinbrenner. Can they be in the network? Who knows? By the way, both those questions, fraud and content quality, are still unsolved, right? Fraud is just part of the system now, but I mean, YouTube, Facebook, they still have the content quality issue. And then third is, turns out, if you have humans selling and then inputting data, trafficking, managing, and reporting on ad campaigns, it's really a lot of work, right? So if you've got 100K buy and you're netting, 30K, and you've got all those humans, like, it actually detracts from your gross margins. It's a lot of work. And so fast forward to today, that problem has largely not been solved, although there's been a lot of things to improve it. I won't go into all the details, but linking the conversation in full. So here are the guys at Swivel. It's a team I've known for a long time, and through a bunch of connections, they launched a couple of years ago with a really interesting technology, which basically says, hey, why are humans involved in all these repetitive processes? And oh, by the way, if you're a publisher and you're managing 12 sites with probably 1,000 concurrent advertising campaigns across across mobile, desktop, you've got display, video, and native, and you're trying to optimize all those things together, it's not a human solvable problem. There are too many concurrent variables. You know what's good at those kind of things? AI. And so that's what these guys do.
So is that because AI can test lots of things, or just because it can handle lots of inputs and just make decisions?
It's state of the art actually today is actually an older technology called machine learning, but whatever, same genre, where you're just able to, I'll put it in practice for you. So in my example, there's a human who's going in and looking probably every hour at all these systems and doing things like saying, hey, you know what? We should increase the bid floor for programmatic display on this site because we have too much demand, right? So they do that, right? And then maybe they can do that 10 more times, okay? A machine learning / AI system can do that 100,000 times, right? Literally. I mean, that's the orders of magnitude we're talking about, right? So, and the revenue creation and the labor reduction is massive, right? So that's a good example of the kind of stuff we try to do.
Interesting. So it's a volume game is what you're saying is AI is a lot better at doing. It's just managing that volume. And
I mean, it's actually interesting. Even the most mundane things now, and to pick your LLM of choice, and it is really fascinating, the content output of these systems. And I mean, I'm talking, so whatever, I have some property upstate and I was like looking at different ways to structure it, blah, blah, blah. And I type in the most mundane things and I will get a detailed outline on what to do with links to the proper state authorities. I mean, it's ridiculous, but it also, you know, if you're Google and you sell clicks, and I forget, I mean, wow, I should know offhand, maybe $80 billion of clicks a year, something like that, maybe more. Well, what does it mean now? Because you can type in your question now and get extracted content in a condensed form. And I don't have to click anything. By the way, Google knows this. They're a lot more than me. They're working on that. But I mean, fundamentally, there are like fundamental ad paradigms that are going to have to shift. And then the attribution of all that content is very blurry. Like, why can the large language model, my model of choice, surface that content and profit on it without actually sharing revenue and or crediting the underlying content sources? In many cases, there are N content sources, it's not one, that are put together. So what do we do? If $1 of revenue comes in, are we going to parse it 86 ways? And how would it be parsed? By word count? I don't know.
Yeah. So we're kind of based in the content space, so we use a lot of AI in what we do. And one of the things is about, it just allows you to create so much more. And there are SEO agencies, for example, who can now just churn out thousands of SEO optimized blog posts that would help Google's more traditional AdWords type model get them to rank higher and get more clicks, etc. But there's just so much that's going to change in the advertising space, in the content space, and the whole marketing space.
And by the way, Google's crawler and AdWords knows that, right? And is going to bump down that. I mean, it's classic cat and mouse of those systems. So it's amazing, really.
Interesting. Finally, then, do you see any opportunities in AI and marketing, given your digital marketing and advertising background, both in the broader landscape, but also for VC and particularly as well?
Well, I will say this: you're starting to see, VCs using AI for their own businesses, right? And so, we actively look at, you can take massive amounts of data sets and glean out really relevant data points. These two employees, their LinkedIn has gone from employee at Google to founder. That's the simplest example, right? But then every permutation they're in. So I know for a fact some of our peers have essentially put every investment memo they've ever written into an AI platform, and then they'll put in the parameters of a new deal. And that system can predict with like 95% accuracy whether or not the firm should invest or not. Right. Now, they're not using that to make investment decisions, but it's an example of the power of these systems. So that's that. And I think broadly speaking, I think AI, listen, I know it's a foundational paradigm shift, right, in the world, literally in the world, maybe the universe, right? So if you look back at adoption curves, generally speaking, we tend to vastly overestimate adoption at the beginning of the curve and then underestimate adoption at the end of the curve, right? So I remember when I first started in 1990s, people were literally on dial-up modems, right? And bandwidth was the gating item to really growth of web content, advertising, because people had to wait. In fact, Google's great innovation was a drop dead simple white screen with a Google logo and a search box, so that it was optimized for a 9800 baud modem. So it just worked on the lowest possible speed connection. But And then they had all these broadband penetration curves that would estimate when are we all going to get broadband. And they vastly overestimated the beginning of the curve. There's no way they contemplated the end of the curve where essentially broadband became ubiquitous.
So where do you think we are now on the AI?
I think we're in the overestimation part of the curve. Okay. We're early on. Oh, hey, it's going to change the world. Inertia is a powerful force.
Yeah.
Right? It's a physical reality of the universe, and it applies to humans and systems and companies and people. Like, it's hard to get people to change, but once they start to change, the pace of change, that derivative is steep, right? So I think you got to push the rock, and then once it starts rolling, it goes. But I will say, what makes the rock move faster and faster is just, it takes order of magnitude changes to systems to break inertia, right? And in AI, you're seeing orders of magnitude improvements to systems, right? So that's where you're going to see really, really rapid penetration and change.
Yeah. And to look back and think about, where the internet and broadband has come, that's we're talking like half a lifetime ago, it didn't really exist.
Yeah.
So
listen,
where's it going?
I'll give you an example of yesterday. My internet went down in my house. It's like crippling. Like, what do you do? And no, I guess it was Sunday, right? Today's Tuesday? Yeah,
Tuesday.
It was Sunday. So not the least of which worked, but also the Knicks were on in a playoff game, and I'm a Knicks fan. Right? So I'm sitting there. What am I going to do? I pulled up my phone, and I had a shitty little 2-band, 2-bar LTE connection, and I did a hotspot to my laptop, and I pulled up Google TV, and I watched the game end to end without a single glitch. Okay. Wow. Now, I would posit that 5 years ago that wasn't possible, right? And now here I am, right? So it's subtle, but I mean, the technology, the technical progression compounds, right? It is a compounding function. And so I just think it's why I do what I do. It just creates more and more opportunity as we go.
Nice. And speaking about what you do, is there any way people can find you if they want to reach out?
Yeah, it's just, we're at TribecaVP.com. And our naming conventions on email are very complex. Mine is chip@TribecaVP.com. And then everybody else in the team, first name at. If you're working on if you're an idea or you just want a point of view from me, just reach out and email. I'm happy to go back and forth on that.
Awesome. Well, Chip, thanks for coming on. It was amazing to have you sharing some of your insights and some of your stories as well. I really enjoyed chatting.
Cool. All good. Thanks.